After a buoyant 2019, Wall Street warns of slower road ahead. New York, AP, after a year of nirvana, investors may need to get ready for something a little more normal. Markets are coming off a fabulous 2019, where stocks and bonds around the world climbed in concert. But for the next year, and decade, in fact, Wall Street is telling investors to set their expectations considerably lower. It's not calling for another crash like the US stock market suffered just over a decade ago. Or for another run like the last 10 years, where the S&P 500 returned more than 13% on an annualized basis. Again, less than half of that may be more likely, both for next year and annually for the coming decade. People need to have a more realistic expectation of what returns are going to be, said Greg Davis, Chief Investment Officer at Vanguard. That means investors who are saving for retirement or for college education will likely need to set aside more, because returns won't be as generous as what we've seen over the last decade. It's not because Wall Street sees the US economy falling into a recession, at least not in 2020, even though that's been a recurring fear for much of the last decade. Much of Wall Street expects the economy to chug modestly higher next year. Instead, it's a simple matter of math. Stocks and bonds don't have as much room to rise after their stellar 2019, analysts say. Starting points matter, and investments began this year at a low point after recession worries pounded markets in December 2018. US stocks will start 2020, meanwhile, close to their highest levels ever. Plus, one of the biggest reasons for this past year's stellar returns, a major about-face by the Federal Reserve to cut interest rates, can't happen again. Why was 2019 so good? Coming into this year, the mood in markets was one of fear. The S&P 500 had tumbled 19.8% between September 20, 2018 and December 24, 2018. Investors were worried that the Federal Reserve was raising interest rates too far and too fast and could cause a recession. President Donald Trump's trade war with China was also threatening economic growth. But markets relaxed shortly after the calendar flipped, when Fed Chairman Jerome Powell pledged on January 4 to be patient. Investors took that to mean the Fed would stop raising interest rates. Later in the summer, the Fed would go even further and cut rates 3 times to shield the economy from the effects of trade tensions and slowing economies abroad. They were the first rate cuts in more than a decade, and the sharp reversal in Fed policy helped relieve investors' anxiety about a potential recession. Lower rates make borrowing cheaper and help industries like housing and autos in particular, where customers typically have to borrow to buy. Lower rates also mean bonds pay less in interest, which in turn makes the dividends par. For more on this story, visit the news article link.